Good morning, good morning. When she says dark side, she doesn't mean Yorkshire, where I'm from, by the way. She means HMRC's sort of investigation and enforcement approach and issues cropping up from the budget about that. So if you've seen me before, that's fine. If you've not, Stephen Outhwaite, I help pieces out with contentious tax issues, and for my sins I was a tax inspector for 25 years, boo hiss, but I left HMRC in 2008 and now work on the light side, I would like to say, but so I see some quite interesting things. So what am I going to talk about today? Yes, I'm picking up on John's football metaphor. As far as tax avoidance and tax evasion goes, the budget, the way the Chancellor divided the budget up, it's a game of two halves, if you'll pardon the pun. There are measures that are being introduced in the Finance Bill this year, and there are measures that the Chancellor flagged up that will be appearing in next year's Finance Bill as well, just to tease us and to trail us all along. So I'll divide my little section up into those two parts. Just a couple of thoughts before I carry on, though. First of all, it's always nice coming to Ewood Park because I'm a Preston North End supporter and we usually do very well here. So there you go, John. Secondly, Anne did me this very nice slide pack yesterday, which I was pouring through last night, but it seems that she must have thrown it up in there at some point in time and then picked the slides up in a random order, so I hope my slides are in. She always gets very tense before these things. And then the last thing, just a thought on each year, as you know, with the budget, we always seem, the way that the tax cycle works is we have an annual cycle of, we have the budget that announces changes, and at one point they swapped the budget around till sort of the autumn time, didn't they? Now we've had a spring budget this year, but in the budget the Chancellor announces the changes. They are then put into a finance bill which has to go through Parliament and receive royal assent, and then it becomes the Finance Act each year. So we always have this annual cycle. And I think John's mentioned this before in previous pace things, but it dates back to the Napoleonic War, this annual tax, because income tax was just supposed to be a one-year thing to pay for the Napoleonic War, and we've been stuck with it ever since then with this annual cycle. Unfortunately, at Paces, we have a great wealth of experience of dealing with tax, and indeed one of our members of staff dates back to the Napoleonic War, and Nadine will be speaking to you later on. He remembers those halcyon days. He waxes lyrical. Sorry, Nadine. Finance Bill 2020 measures. So we've got reform to the off-payroll working. So IR35, if any of you work in the sort of recruitment sector, or if you have either a contract with your own personal service company, or if your business has used such contractors, you will be aware of IR35. And just for the uninformed, what is it? It's a means to ensure that any individuals who work through their own company, personal service company, but contract into another entity, if they're working like employees in that entity, rather than being generally self-employed contractors, not being supervised, directed and controlled by the end client, then if they look like employees, if they smell like employees, if they work like, I don't know what employees smell like, but if they work like employees, then they pay broadly the same amount of income tax and national insurance as individuals who are employed directly. And I've underlined work like employees there because that's the key thing. If they are the same as other employees within that business, then the government believes that they should be paying pay-as-you-earn and NIC as employees. And I think the government would really like to get everybody on a payroll somewhere because it makes it much easier to corral and control them and to get money in more speedily than if they're working through their own service company. So that's what IR35 is. It's just a method by which HMRC can try to control those things. It was extended into the private sector with effect from the 6th of April 2020. So it's live, going to be live with effect from the 6th of April. It was flagged up before in the last budget, which was the Halloween one at the Duncan Hall. So I did mention this. The government flagged it up then. And they've got a habit these days of flagging things up a couple of years before they actually happen, and then kind of reheating them a bit near the time, which gets a bit tedious after a while. I was hoping for lots of new things this year because I like change, but a lot of the things that have come out this year have been pre-trailed by the government. But the reform with effect from the 6th of April 2020 places responsibility for assessing whether IR35 applies and whether somebody should be dealt with under pay-as-you-earn or not onto the private sector end user of the contractor's services for all payments by medium and large businesses. Just hold that thought and I'll come back to that. So it's medium and large businesses it affects, with effect from the 6th of April 2020. Where it's concluded by the end client, who is now responsible for assessing whether it pay-as-you-earn is applicable or not, then the fee payer, so if it's the end client, then they become responsible for accounting for and paying the related tax and national insurance, including the additional cost of employers' national insurance to HMRC. The new rules apply only to medium or large businesses, if you recall, I said, in the private sector who are the end user of that worker's services, and to the fee payer if it's different. For example, fee payers in the recruitment sector. So if you're in recruitment, then you need to be aware of this. What's medium or large? It's the traditional test. So the accountants in the room will tell the traditional test for determining whether the size of a business. It's broadly 2 out of 3 of the following. The business has a turnover of more than £10.2 million. Balance sheet total, i.e. assets of more than £5.1 million and 50 employees or more. So if you hit 2 out of 3 of those, then you are a medium or large business and you need to be considering whether the changes apply to you. If you're a small business, then it still remains the responsibility of the workers' intermediary, so the personal service company or whatever. They remain responsible for assessing whether the engagement is within the scope of IR35 or not. Okay. How do you determine status if it's now your responsibility to do so? And this has been kind of pre-trailed by HMRC on their website, so I'd like to think that we've got a handle on this already if it's going to apply to us. But HMRC have got a tool, it's called the Employment Status Tool. You can go onto the HMRC website and use that, and you just fill in questions about the engagement and it churns an answer out at the end. It's not always the right answer, I find, and it can be easy to trick to get the answer that you want, which isn't always ideal, but that's your starting point. If you're not sure, as with everything, then come and talk to us because we can help you out. Key things there are, if you're determining somebody's status, you must be able to show that you've taken reasonable care when you're doing so, because if you get it wrong and HMRC come and have a look, then they can unleash shock and awe, doom and brimstone and all those kinds of things if they come and investigate and you've got it wrong. You're not taking reasonable care. You have to keep records of what you've done and why you've done it. You've got to pass a copy of your determination onto the worker. So there's an audit trail that needs to be kept to show that A, you've taken reasonable care, and B, you've communicated that decision onto the worker. So as I say, come and see us if you're not 100% sure. So that's IR35. The next thing that the Chancellor flagged up as being something that is going to be enacted in this year's finance bill is the government's response to the loan charge review. Now, if you're not familiar with the loan charge review, in a nutshell, it was all to do with what the government called disguised remuneration arrangements, where people who, it's usually directors of owner-managed businesses, where they decided that, in conjunction with somebody usually selling something like an employee benefit trust, a tax planning, stroke tax avoidance, call it what you will, arrangement, it was all to do with, rather than me getting paid with pay-as-you-earn and NIC applying to my remuneration from the business, can I do some clever planning around offshore trusts and smoke and mirrors and get my money out into a trust, and then it comes back to me as a loan? And the salesman said, salespeople, salespersons, got so confusing these days, isn't it? If it's a loan, then pay-as-you-earn doesn't apply. Of course, that was always a little bit flaky at the best of times, and I, as a former tax inspector, would tell anybody that, in my view, you need to be very careful before you do that, because if something looks too good to be true, it generally is. And surprise, surprise, HMRC investigated a lot of these, and tax tribunals looked at them, and the courts looked at them, and said, actually, yeah, pay-as-you-earn should always apply, so we will investigate. But HMRC being HMRC, they didn't always pick up on these cases and investigate them at the right time and kind of missed the boat with them. So they introduced this thing called the loan charge, which was effective in April 2019. And what that broadly meant was if you had participated in one of these arrangements at any point in time in the previous 20 years, even if HMRC hadn't investigated, they'd missed the boat, then if that loan remained outstanding at April 2019, you still had to cough up the tax and national insurance with, do not pass go. HMRC doesn't need to do anything else. It was a quite outrageous piece of retrospective legislation, effectively, and unsurprisingly caused a lot of distress. There was documented suicides over it, representations made from all over the place to the government, to HMRC, about the nature of it, including MPs, some fairly prominent members of Parliament. And long story cut short, eventually, to my astonishment really, the government did start to listen, having tried to deflect and deflect and deflect. They did listen. They commissioned a review of this loan charge that, again, to my surprise, I expected it just to be a whitewash to say, well, if you engage in any kind of tax avoidance, then don't be expecting any sympathy. But the review was actually quite balanced. It was by Sir Amyas Morse, and it said, actually, it is disproportionately harsh. It does override some of the safeguards that you can expect as taxpayers. And it there was a number of kind of softenings of HMRC's approach. What Amyas Morse said was anything sort of pre-2010-11, even if it is still outstanding in 2019, HMRC cannot go after it. You don't have to account for the pay-as-you-earn and NIC, so that can't be done. Post-2010 up to 2016-17, if you had disclosed in company accounts or made some kind of disclosure that this thing that you had got an offshore arrangement along these lines, if HMRC haven't picked up on it and acted upon it, then again it's too late for HMRC. So so that also shouldn't be affected. But if HMRC have already started inquiring, they're within their rights to continue with that inquiry, and anything after 2016-17 is still up for grabs. So it's a welcome softening. What did happen was a lot of people got spooked by this and settled with HMRC, and it might be the case now that those settlements should have fallen away under the rules that follow the loan charge review. So if you have settled on some kind of employee benefit trust issue with HMRC and you think that that settlement is now no longer sort of compliant with the rules, then you can unwind it. Come and talk to us if you wish to do so. And HMRC have said, yeah, we'll repay money that's been paid over that shouldn't have been paid over. And a lot of people did get spooked into it because it was such a draconian measure. So it's just worth being aware of that. But that's now going to be legislated. HMRC said when the review was published in November, December, well, we need to wait for legislation before we can kind of formalise anything. Well, the legislation is now going to be in place this year, and you can act on it. So that's worth bearing in mind. So that's the fact. So there's only two things in the finance bill, but there was a lot of things that were flagged up that are going to come into effect over the next year or so. Tackling another footballing analogy. What could I have done there? I'm that clever. Tackling promoters of tax avoidance. I spoke about employee benefit trusts and things like that. They were generally pushed by kind of boutique sort of tax planning businesses. A lot of big firms did them as well, to be fair. When I, without naming names, I worked for a very large accountancy practice, a national one, for 4 years after leaving HMRC, and we had a department set up there flogging these things left, right and centre, and they made an awful lot of money out of them. And I said at the time, I'm not very comfortable with this, but, what can I do? I'm only a small cog in a big wheel. But, surprise, surprise, these things have all come crumbling down. But promoters of tax avoidance, what do they look like? As I say, mostly bespoke for, little boutique-y type firms. But some of the bigger firms have been involved in it. The world has changed since then. And, I know particularly at Pearce's, there's the bodies, like the ICAEW and the Chartered Institute of Taxes, their advice to members that Pearce is very keen to stick by, and their advice is don't do anything like any kind of marketed arrangements. They don't work. And my advice to anybody in this room is, if you are approached by somebody in a shiny suit from one of these boutique places, because they are still out there, be very, very careful, because, as I say, if something looks too good to be true, it is. The better approach to any kind of tax planning arrangement is something bespoke that you spoken to your advisor about, and it is tailored to your particular needs, and it is risk assessed for compliance. That's the best approach, because when these things go wrong, and you take it from me, I've acted for a lot of clients who've had problems, they can be life-changing, some of them, and there have been. So without being over dramatic, the loan charge thing with employee benefit trust, people have killed themselves over it. So you have to be careful. The government don't like promoters of tax avoidance. Surprise, surprise. They've already legislated in Finance Act 2017 that where a firm sells some marketed tax avoidance to whatever business it is, and that arrangement is then defeated either through investigation or through litigation if it goes through the courts, then the promoters of that arrangement face a penalty of up to 100. Well, it's not up to; it's 100% of any fees that they've derived from that arrangement. So promoters includes the people selling the scheme, any accountants involved in it, any solicitors, any company formation agents, any banks that are involved in it. So they already penalise promoters, but the government want to further tighten the screw on promoters. They're introducing further measures next year, so they're going to produce draft legislation in July 2020, which will be introduced next year to make changes to the existing regimes that tackle tax avoidance. The government's also going to be throwing a lot more money at this. Rishi Sunak announced that. Changes will come into effect following the royal assent next year. Now, we don't know what those changes are going to be yet, but as I say, it's going to be a further tightening of the screw. We'll have to see what the draft legislation says, but come and talk to us if you're contemplating doing something, and if you get some marketing blurb from one of these boutique firms, then treat it with caution, and come and have a word with Nadeem if you're not sure, because he will, we can kind of risk assess that. Sometimes it might be something that's very good. You never know. I'm not trying to poison the well for everybody, but just be careful. HMRC have also themselves said they will publish a new, quote, ambitious, unquote, strategy for tackling the promoters of tax avoidance schemes, and they want to drive these promoters out of the market if they can. They've been successful to a great extent. A lot of them have disappeared, leaving a lot of disaffected former clients behind, who are the ones that I tend to pick up the pieces for. They want to disrupt the supply chain to stop the spread of these marketed avoidance schemes and deter taxpayers from taking up the schemes, or to paraphrase it in words that I understand, they're just looking to poison the well over this, and I think they are being quite successful in doing so. Yes, identifying cross-border arrangements that could be used to avoid or evade tax. Now, I'm not talking about the border between Yorkshire and Lancashire here. I'm talking about any sort of cross-jurisdictional transactions in your business. You're advising businesses that have a foot in more than one jurisdiction. Just need to be a little bit careful. There's always been things like the transfer pricing rules where the government can, or HMRC can, tackle artificial shifting of profits from one jurisdiction to another. I had, in my glory days in HMRC, I investigated a business that was UK-based, but it sold T-shirts, and it had its T-shirts manufactured in Nepal. And at first I thought, why on earth are they doing things in Nepal? But you look a bit closer, and they're paying, or on the face of it, siphoning an awful lot of money from profitable UK company into the Nepalese company, and it's zero corporation tax in Nepal, so it was not difficult to see why they were doing it, and it was all completely artificial, these arrangements. So it's that kind of thing that the government are looking to challenge, as they always have done, but they're going to look to introduce new regulations to tackle this, and it's a bit like the disclosure of tax avoidance scheme regime. What the government are going to be saying is there are particular hallmarks, and if your business is transacting cross-border and you hit these particular targets, then you need to tell us about it, HMRC. And the bottom line is, if you distill the hallmarks down, it's principally what's the main benefit of the arrangement. If it's commercial, and if you're paying an arm's length price, then that's fine. But if it's not commercial and you're just shunting profits elsewhere to take advantage of a low tax jurisdiction, then HMRC will want to know about it. Construction industry scheme, there were a couple of measures that are going to be introduced to further tackle abuse in the construction industry scheme. So the government are talking about in Finance Bill 2021, i.e. next year, looking at legislation to prevent non-compliant businesses from using construction industry scheme to claim tax refunds that they're not entitled to. That's going to give HMRC the ability to reduce or deny any CIS credit claimed on employer returns where the subcontractor can't evidence the deductions and doesn't correct the return when asked. There's going to be some simplification of the rules as well, particularly covering deemed contractors, clarification of rules on allowable deductions for expenditure on materials, and expansion of the scope of the penalty for supplying false information for the construction industry scheme. Okay. So that's next year, so just be aware of it if you're engaged in, or if you have any contact with the construction industry scheme. Conditionality, and again I mentioned this one last time, it was flagged up a couple of years ago and it's been flagged up again. It's not coming in this year but next year. What do I mean by conditionality? It's where a business needs a licence to operate that it has to apply for, then the granting of that licence in future is going to be conditional on the business being able to prove to whoever issues the licence that they are HMRC compliant. Specifically, it's to do next year is to do with licences to drive taxis, drive private hire vehicles, operate private hire vehicle firms, or deal in scrap metal. So they all require some kind of local authority registration, and whoever wants the licence is going to have to demonstrate their compliance with the, i.e. that they're registered for tax. The licensing bodies have to obtain that confirmation before making a decision on any renewal or any application. There's also going to be a discussion document this year on wider application of that, so moving away from taxes and scrap into other parts of the economy. So we'll have to see what that discussion document says. Raising standards in the market for tax advice. So the government, we don't know what they're going to do here other than they're going to publish a call for evidence on raising standards in the market for tax advice in the spring, seeking evidence about the providers of tax advice, current standards upheld by tax advisors, and the effectiveness of the government's efforts to support those standards, just to give people more assurance that the advice they're receiving is reliable. Oh yes, and finally from me, and HMRC seem quite keen on getting us to do their jobs these days. They're, I suppose as they get thinner on the ground, they have to work a bit smarter. There is going to be a requirement from April 2021 for large businesses, so generally if you're dealing with HMRC's large business service, this is going to apply to you. Required to notify HMRC when they take a tax position which HMRC is likely to challenge. So that'll be interesting. What all joking aside, what you generally find with these large businesses is that they have face-to-face contact with a named individual HMRC who's their customer, they call it customers in HMRC laughingly, customer relation manager, and they usually have this conversation anyway, but there is going to be a requirement specifically for businesses to notify HMRC when they do take a tax position which they think may present HMRC with some problems. So that's another interesting one. So so on that bombshell, I think I can now and I stayed at the hotel Jeremy Clarkson stayed at a couple of weeks ago when he, on that bombshell, when he punched his producer, Simon Stone Hall in Yorkshire. They've got a plaque on the wall at the bar and it says, "This is the spot where Jeremy Clarkson's BBC career ended," which I thought was lovely. Very nice, highly recommended. Anyway, Nadine, over to you. Thank you.